good morning, everyone. And thank you for tuning in to this 30-minute Fireside chat on ETFs, where we will hear the latest views and insight from our ETF expert panel. I'm Victor Österbo, and I head up the institutional trading desk at ETF market maker Flow Traders. We're on a tight schedule today, so let me quickly introduce the panel, and then let's get started. So with me today, we have Mrs. Jacqueline Pang, Head of ETF Capital Markets, Asia Pacific for Spider State Street Global Advisors. Jacqueline has over 10 years of experience heading up ETF Capital Markets teams in both Asia Pacific and in Europe. Next, we have Mr. Alex Chan. Alex is a seasoned member of the iShares Global Markets team at BlackRock in Hong Kong, helping clients day-to-day navigate ETF execution and trading in the global iShares ETF range. And last but not least, Mr. Jürgen Blumberg. Jürgen is head of ETF Capital Markets EMEA at Goldman Sachs Asset Management, based in London. He has an equity trading background, followed by 11 years of experience in the ETF industry. Before joining Goldman Sachs Asset Management, Jürgen was responsible for the ETF Capital Markets team at Invesco, and he started his ETF career at iShares in Munich. A warm welcome to the panel, and let's dive right into it. Jacqueline, perhaps I could start with you. In this challenging and volatile year that we're currently in, how would you say that ETFs have fared and held up? Have they delivered on investors' expectations? And are they more interesting today than they were a year ago? What do you say?
Yeah, thank you, Victor, for the introduction, and hello, everyone. So I think just for the first half of this year, ETF has proved to be resilient. We have seen the unprecedented market volatility during this whole COVID pandemic. And obviously, this is not the first time where we've seen the ETF structure that has been tested. It has been tested once again, and I believe that it has lived up to the function as it's intended. Some of the key observations we have seen, first of all, when we look at the ETF trading volume, it has reached the record trading volume for the month of March. The US listed ETF has traded close to 5.3 trillion, which represented about 39% of the US equity market volume. And this, when you compare it with compare it to last year in 2019, ETF represented 30%. So when we look at it, that actually suggests an increase in ETF usage, whereby the clients are actually gravitating ETFs for exposure, for liquidity during this extraordinary market stress. So we have also seen similar increase, not just in the US, but also in EMEA and also in APAC. So I think just on the other side of the equation is that there are also a lot of discussion that went through, pointing fingers saying that ETF could be the culprit of this increased volatility in the market due to the fact that it's also highly correlated to the trading volume. So what we view is that investors basically turn towards ETF is because they actually can make real-time asset allocation, and ETF is able to provide liquidity when investors actually demand it most of all during this period. So when we look at just volatility alone, we also look at the primary market, so basically the underlying market. While the ETF volume, trading volume is high, the trading on the underlying market remains relatively low. That represents, I mean, the US ETF represents only about 7% trading volume of the whole entire common stocks in the US. So in a way, ETFs also acts as a liquidity buffer during the volatile period. Then moving on to bid and ask spreads, that's when we see, I think everyone will also agree that we have seen basically the spreads widening up across all asset class due to very challenging market condition. We have the market makers that needs to basically manage the risk, so they're pricing in their market risk. The hedging costs has increased. They will have to basically manage the risk due to the elevated volume. But then these are all in line, pretty much in line with the underlying market condition. And then on the fixed income side, we have also seen very huge, significant dislocation between the ETF and also the NAV pricing, creating a much wider than normal, I would say, discount rather than premium. I think this is where basically the price discovery come in place, whereby ETF price basically move faster. It's able to incorporate news throughout the day, whereas the NAV, that's when they consider it as stale, because the NAV is only calculated once a day. So somehow there's been also a lot of questioning about fixed income ETF performance during the month of March. but we do believe that the discount is accurately priced because that is able to reflect real-time market sentiment and also the liquidity, whereas the bond price itself basically lacks the realistic trading level, is level that whereby clients basically can't execute. So just to sum up, I would say that despite all these challenges on this market condition and quality, ETF did deliver. It did provide liquidity. It did provide the price transparency to the marketplace. I think the whole ecosystem has been tested. Market makers has done their job. Authorized participants, the stock exchange, the regulator, they have all come in place to deliver this whole infrastructure that perform efficiently as it is.
Alex, what do you say about this? Do you agree with Jacqueline?
Oh my goodness, that is exactly what I want to talk about. Jacqueline definitely highlight the key things ETF achieved in the first half of this year. I definitely see the same resilience in the first half of this year. Go through multiple tests. First one obviously went through the unprecedented market volatility, and second one's actually the extreme condition in the underlying OTC bond market since GFC. So in terms of market volatility, we both all witnessed the fact that whenever there's time of stress, ETF trading volume increase. So this time, same as what Jacqueline observed, ETF actually trading volume increased during the time of stress globally, no matter how you look at it as an aggregate number or as a percentage of the equity market volume. So actually, we do some more detailed actual number. In fact, if you look across European ETF landscape, they trade close to $400+ billion on a monthly basis, which is almost like 230% larger than the average trading volume in 2019. Same thing as Jacqueline mentioned about US $5.4 trillion is a massive, massive increase in the turnover. So it will be very hard for me to comment whether these observation meets the investor expectation or not, but the actual volume demonstrate the fact that the investor has been looking to ETF to allocate the capital, adjusting the position, and managing the risk during the market turmoil. And second of all, I do see that ETF have passed a test of the extreme condition under the OTC bond market. I was actually working for a fixed income house back in GFC. Comparing to what I have seen in the first half of this year to what I've seen before, this is very, very drastic. So think about when bond markets actually liquidity dried up, we saw investor increasingly rely on ETF for the fixed income exposure, all backed up by the ETF trading volume. And also, Jacqueline also mentioned that a fixed income ETF perform real-time pricing transparency to the bond market actually price. When a lot of times the underlying OTC bond are not tradable or the market itself is just frozen. So overall, it is a very, very interesting year for me, and just too much to comment comparing to any other years combined.
Thank you, Alex. And I mean, even though Jacqueline was trying to steal the show a little bit and answer everything, you still managed to find a few additional points. So thank you for that. I had a few questions prepared actually, but I'm going to reshuffle a bit and ask you, Jürgen. Any comments here? I mean, you're the only one in the panel who is based not in Asia and sitting in London.
Yes.
What do you say?
Yeah, so thank you very much, Victor, for choosing me as the third person because now really all the points are covered. But I thought I might highlight a little bit the growth figures, the impressive growth figures of the ETF market, and have a little bit of a global view on that. So I fully agree with Jacqueline and Alex that during the volatile periods in March and April, ETFs did very well. And they delivered what they promised. And as Jacqueline said, they often acted as price discovery tool as well, which is very important. So investors rely on ETFs and continue to rely on them. And as a result, we see impressive growth. And when I look at the ETF industry globally, we see now approximately $7 trillion being invested into ETFs. The biggest market is obviously the US with $5 trillion in US domiciled 40 Act funds, followed by Europe, $1.2 trillion invested into UCITS ETFs, and then approximately $1 trillion in Asian domiciled products. It's the smallest market, but it's growing the fastest, which is very interesting and very interesting for global issuers as well. So when we look at the net asset or net new assets figures in Europe, $65 billion have been invested year to date, predominantly in gold and corporate bonds. US and Euro corporate bonds have been really demanded. And when I look at the asset classes which were sold, then it's predominantly EM benchmarks, EM bonds and EM equities. The exception, interestingly, is China bond. There were a couple of Chinese bond funds launched in Europe, and there's big demand for that from European investors. And again, I want to repeat that it's very impressive that on a monthly basis, globally, approximately 40 billion are invested into ETFs. So 40 billion fresh capital into this category, which proves again that it did very well throughout the crisis. So which are the kind of trends which we really see emerging over the last months and few years? We see now 100 billion US dollar being invested into ESG products globally, and more than half of that is in Europe. And I think this will be a trend which will be more global in the future. We see as well that smart beta ETFs have attracted 1 trillion. So in comparison to the 7 trillion which are in ETFs globally, it's a small figure, but it shows that this smart beta category attracts more and more investors. And we think that's a global trend as well. And one trend which I want to mention, and maybe we cover this later in more detail, is retail adoption. When I look into the US, it's all about the advisors. Our biggest fund has now passed by the 10 billion mark, and it's fully based on advisors buying into this product. So it's really advisor driven, it's retail driven in the US. And when I look into Europe as well, we see that retail adoption is really taking pace. When I look into Germany, for example, there are now more than 1 million ETF savings plans. So those are people who put money into ETFs on a monthly basis. And I think that's a very interesting trend, which comes from the US, is now in Europe. And I think we will see far more of that in Asia as well.
Thank you, Jürgen. I basically agree. I think we could do a far longer panel only on sort of discussing what is required for more retail adoption. But that's for another day, perhaps. Alex, if I could come back to you, have there been from, let's say, in the Asian markets, right? Have there been any important changes or news or structural improvements to sort of further enhance the ETF growth this year?
Absolutely. Definitely, thanks for bringing back to home, Hong Kong, and the recent changes that we have seen in the past only a few months' time. So the first off, definitely is the Hong Kong Exchange new ETF spread table, which potentially can reduce ETF tick size and boost competitiveness of Hong Kong as a liquidity platform for ETF. And second of all, the Hong Kong Exchange introduced the stamp duty waiver for ETF market maker. You guys will be one of the beneficiaries, right? Where ETF market maker can now potentially enjoy zero stamp duty in the stock transaction when they create redeem ETF units, whenever those underlying stock are Hong Kong equity as the underlying reference assets. So combining both, I think that will be overall lower the transaction cost for ETF market maker and potentially release more liquidity into Hong Kong ETF marketplace.
Yeah, I agree, and that's the beauty, right? If you combine improvements and at the same time make sure that you have plenty of competition, then basically all those kind of savings goes into tighter markets and benefit the investors who use them. So I agree. Keeping the line there perhaps a bit on let's say ETF usage and a little bit on liquidity and trading. I mean, ETF usage among institutions in Asia have grown tremendously the last few years, no matter what metrics we look at. But also, and this is something I have seen a lot of as well, we still receive more requests for prices on US listed and European listed ETFs compared to the ones listed locally in Asia, in Hong Kong and beyond. Jacqueline, why is this, you think?
We do receive the similar requests as well. I think given that Spider, we do have a global range, I think just looking at the product scope here over here in APAC or in Asia, we do see really a very limited product scope. So can't really blame the investors for seeking exposure that they require on the US and the US's ETF. So products that are being requested here during Asian hours from our Asian investors are usually not products listed here in Asia. Would lack of liquidity be an answer? I would say not really, because I think we have been educating, doing our job, educating our investors. There's always also a notion by saying that there's no bad student, there's only bad teacher. So I wouldn't use the lack of liquidity as an excuse. I will point out more on the impact cost, or should I say the whole total cost of ownership, as a potential reason, because this is harder to quantify and harder to be, because it's harder to quantify, so it's often overlooked by investor. Investors that are using the US or uses ETF trading during Asian hours, there will always be a opportunity cost to capture market movement when that actually happens during Asian hours. So, but then we did see an improvement on this front, because we have take gold example, that is the theme for this year. So Spider Gold share that is actually listed here cross-listed in Asia, primarily listing in the US. This year it has actually hit the record trading of 120 million on the Hong Kong exchange, because investors are starting to recognize that they should not wait to US hours to open to express their views. So I think, yeah, definitely an improvement on this front.
Alex, care to comment?
Sure, I'll make it very short. It's actually a few reasons why I think will make a difference, including the global product range, AUM, and the perception about liquidity. Just think about globally, we have 6,900 ETF lists across the board, Hong Kong, Asia, US, Europe. Think about, as an Asian investor, if you need to look for an exposure, you will stick with the one that you remember the most, even though there might be an equivalent Asia listed exposure, cheaper in terms of cost, TCO, you named it, for you to use. So that is the one thing that we are continuing committing to investor education about, promoting the awareness of the Asia listing, where it fits to the Asian investor in terms of cost efficiency. So I think education is the key to get the awareness out.
All right, thank you. And Jürgen, what can Asian investors learn from the European and US counterparts, and the other way around them? What can European investors learn from Asian investors in your view?
Yeah, I think there are a lot of lessons to be learned from each region. And maybe first of all, if we look at Asia and at Europe, they're very similar, because both are very fragmented regions. There are different currencies, there are different regulation, different exchanges. And I would even think that Asia is even more fragmented than Europe is. And there's a big difference to the US, where it's all harmonized. And we see effects of that on ETF trading. So we see in the US that 70% approximately of the ETF trading is on exchange, and just 30% is OTC or via requests for quote systems. However, these requests for quote systems are growing fast in the US. And when I look into Europe, then it's exactly the other way around. So in Europe, 70% are traded via RFQ or over-the-counter systems. And in Asia, I think a lot of ETF trading is via brokers. They love to use algos like time-weighted average or volume-weighted average, market on close. And there's often a commission payment involved when using these brokers as well. So I think each of these ways of executing has their advantages and disadvantages. So there are clearly lessons to be learned, but we really think that these RFQ systems, that they will be adopted globally even more as they have been so far. And another point I want to mention is when I look into ETF usage, I mentioned this point of retail investing in the past, and we observed that in Asia, it often seems that Asian retail investors, they almost jump from not investing to using ETFs. And in Europe and in the past in the US as well, obviously there's a big legacy of using active mutual funds. So the retail investors, they often use mutual funds, and it's very hard to convince them or to educate them about the advantages of ETF trading or ETF usage in general. And when I look into the institutional client space in Asia, I think in comparison to Europe and maybe in comparison to the US as well, we think they are very flexible, they are very innovative, and they're very well informed. So that's why we think, or that's why we see that the Asian ETF market is growing so fast. And obviously Asian investors, as you just mentioned, they like UCITS ETFs for the ETF structure, they like US ETFs for the visible liquidity, And this will be very interesting how this growth manifests going forward and which of these different kind of solutions and wrappers will be used most frequently in the future.
All right. And Alex, do you think, I mean, Jürgen mentioned that this RFQ trend, electronification of trading, request for quote tools, etc., that is growing quickly in the US, that in Europe it's very well adopted. Is that, you think, something that will be coming more in Asia as well? Could it be helpful to Asian investors, or how do you see this sort of discussion?
So I will confirm that will be useful for Asia-based investors to trade global range or local range, because there's an alternative way for them to trade large size using these electronic platforms. So I do agree that this is something useful for the Asia-based investor to use going forward.
Understood. Thank you. Okay, looking a little bit ahead, the clock is ticking. But I mean, you all interact with institutional investors of all kinds on a daily basis, and I mean, you've been doing so for years and actually for decades. And I mean, where do you see the biggest potential for growth in the coming years or so? And again, especially from an Asian investor perspective, Alex, what do you say?
Sure, among multiple themes that I look into, including ESG, thematic, definitely look, I have to call out fixed income ETF this year. So as you know, Asia-based investors share a very similar theme to our global clients. As I mentioned earlier, fixed income ETF provide deep liquidity, continuous price discovery, and ability for investors to just buy and sell a basket of bonds on exchange to manage risk in those extreme conditions is very critical. So as a result, we have seen global pension client, insurance, asset manager ramped up their adoption in ETF. Within iShare, we count close to 60 asset owner, asset manager. We're the first time buyer of fixed income, iShare fixed income ETF in the first half of this year. So it will be a significant room to grow in this space. To put it in perspective, think about at the end of June, the global fixed income ETF assets account for close to $1.3 trillion and is actually growing 30% year to date in 1 year. But it only represents a fraction of the $100 trillion global fixed income security market. So assume the same growth pattern happens in the future. I believe that institutional investor will help expand this global ETF range to $2 trillion by 2024. So within iShare, we do see similar trend to our flow as well. Year to date, we see close to $70 billion of our fixed income ETF flow, with total assets of total around $650 billion in assets. So this trend is one trend to watch out, fixed income.
Jacqueline, care to comment? What do you say? What do you think? What are you planning for?
Well, I would say two things. First of all, I would say the fixed income. No one, I would say, in this room would disagree that there is a very bright future for the fixed income ETF. Year to date, not only has it gathered 142 billion, it is close to breaking 2019 record. We are just shy of 13 billion. So this asset class is likely to be the new record holder, since there's still 4 months to go. So the question is not whether will it break the 2019 record, but it's by how much. So I think that the explanation is pretty straightforward. I think investors specifically for income in this low rate environment. But then more so, I think we do see the real demand actually come from investor when they really start to recognize the flexibility of fixed income ETF. They start to understand the usage between tactical allocation, cash equalization, and so forth. I think what we have noticed is that since mid-March onwards, that's when we really see the demand come right through, especially after the structure has been very significantly tested in March. And that really shows a strong sign of investor that actually show confidence in this vehicle. The second theme, which we see, probably wouldn't call it a short-term growth, but it's definitely the next generation thematic fund. This whole COVID has changed the way we live. new trends in our society, the way we live, the way we consume for things, for media to stay connected. So some of the trends are already in place. Some would definitely be amplified as we go forward in this very digitally connected world. So as we move towards, for example, some of the trend, cybersecurity, to defend cyber risk, when we basically move towards virtual goods and services, we start to do more digital payment. That would be a standard. So cybercrime is bound to increase. Cloud computing, I think we all need software to support our daily life. So obviously during this whole period, we would see definitely an increase in such platform. So this is just some of the themes that investors are looking to seek out specific exposure, which might not stick to the market cap or the standard sector, because some of the things that are considered discretionary might right now become stapler. Things like streaming, 5G network, and so forth. So there might be a switch on that front. So thematic, new generation, something to look out for.
A few various listed ETFs in various parts of the world from a long range of issuers actually on that theme. Jürgen, our man in London, feel free to comment on what's already been said, but I would also like to ask you a little bit in terms of growth and expansion initiatives. How do you guys at Goldman Asset Management view APAC versus Europe and the US? Is it sort of the same to you, or anything that sticks out? Anything you could say there, please?
Yeah, thank you very much. No, very happy to focus on that. But first of all, I'm obviously covering this fixed income ETF trend, which Jacqueline and Alex have just mentioned. So even in Europe, we see now for the second year in a row that there are more assets going into fixed income ETFs than in equity ETFs. So it's the second year in history that this happens, and it's very impressive, obviously. And we think this trend clearly continues. So as Goldman's, we are a global ETF business within a global company. And we launched our first ETF in the US 5 years ago. And we now managed to attract 23 billion assets under management. In Europe, we launched less than a year ago. So we are quite a young ETF team in Europe. And obviously we have the US to aspire at the success which they had and want to do the same for Europe. But our ETF strategy is, in short, to make Goldman Sachs strategies and content, which was in the past just accessible for a few. We want to make this accessible for all investors. And our focus is on smart beta and on solutions for investors. So, for example, China bond, which was hard to access in the past, we make this accessible in an ETF structure. Excuse me. And that's especially interesting because Chinese bonds are now included in many global bond indices, and we see big investor demand for this asset class. We have in Asia local sales, obviously, covering the regions. As a global institutions, we are very strong in the different regions. And in terms of product team, ETF product team, we are based in London and in the US. But we have local portfolio managers as well in Hong Kong. That gives us a specific edge, and we can cover the local market better from a portfolio management point of view in our ETFs. And as you mentioned before, Victor, all of us, we have many conversations with professional and institutional clients. At the moment, we are most focused on Japan, Australia, Singapore, and Hong Kong. That's when I look into my books, that's where we have most of our conversations at present. And as a company, obviously Asia and particularly China is a key focus area. That's, I guess, not a surprise. I think that's for all of us, but we are very focused on Asia, and we want to deliver solutions and products for the Asian market.
Sounds good. You have to answer quickly, but will you be listing a lot of products locally in the region? And not a long answer now, my friend.
At the moment, US products are listed in US, and our European products are listed on 4 European exchanges. At present, we do not plan local listings, but please, investors, if you tell us, we always can do that for you.
Nice, you got a little commercial in there as well. Okay, thank you for that. Sorry, we're unfortunately coming very close to the end. This is a rather short fireside chat. Perhaps to sum the last 30 minutes up, I would say that the panel agrees that ETFs look more interesting than ever, having once again proven their value proposition in times of tremendous stress. As for Asia growth outlook, in terms of both usage and listing, we're likely to see more alternatives and also better trading capabilities with the trend towards electronification of trading via request for quote tools. Then it just remains for me to say thank you to our great panel of experts, and a big thank you to all of you who have taken the time to listen to us today. I wish you a great day ahead and all the best. Thank you.